Hello and welcome to A View from the Fields, the new visual guide to the news of the month. Today we're covering the UK debt, President Trump's inauguration, how it will affect the markets. We'll also be covering further effects of the budget on the economy as we see it pan out in real time. Again, the aim of this video is to keep everyone updated on current events, and this no way constitutes any form of advice. So let's start with the big picture. Last week, long-term interest rates on UK government debt spiked dramatically. What's driving this? It's a toxic combination of the US economy surging ahead with strong growth prospects, while in the UK, we face what has been described as a funeral economic landscape. It doesn't help that an anti-growth budget unveiled days before Trump was elected seems to have left global investors demanding higher returns for lending their money to the UK. The debt markets, as one expert put it, are essentially a global popularity contest for money. Right now, Trump's America is winning. Meanwhile, in the UK, well, we seem to be the ugliest horse in the glue factory. This financial turmoil has real-world consequences, and the ripples are being felt everywhere. Labour, just 6 months into government, is already facing the heat. Days of negative headlines about so-called economic chaos are casting long shadows over their polling numbers. For business, the picture is bleak. CEOs are raising alarms, accusing the government of touting itself as pro-investment and pro-growth while implementing policies that do the opposite. The higher interest rates are pushing up borrowing costs across the board, and when you add increased national insurance contributions and tighter environmental regulations, it's no surprise that confidence is taking a hit. And it's not just business that's feeling the squeeze. For ordinary voters, the pain is hitting closer to home. Anyone with a variable mortgage or whose fixed rate is expiring is now staring down the barrel of higher monthly payments. Capital Economics, a leading think tank, predicts that UK mortgage rates, currently are at around 4.5%, could climb to over 5% in the coming weeks. So much for Labour's campaign, promise of economic stability leading to lower bills. Here's the reality. As the government debt servicing costs rise by as much as $12 billion per year, there's less money for schools, hospitals and infrastructure. And the Prime Minister's pledge of no return to austerity, well, that promise seems to be written in pencil. Treasury insiders are already bracing for tough decisions. They're hinting at a painful and unpopular cut to public services. A bitter pill for Labour MPs who were elected on promises of improved public services. Behind the scenes, tensions are rising. There's growing discontent on Labour backbenches, with murmurs that Rachel Reeves, the Chancellor, might not be the right person for the job. And then there's the global money markets. Reeves' decision to increase borrowing by $30 billion a year is now looking dangerously reckless. Fiscal rules she set for herself are hanging by a thread. March the 26th is shaping up to be the next big test. That's when the Office for Budget Responsibility, the UK's official economic watchdog, publishes its spring forecast. If the OBR finds that the government spending commitments have broken its pledge on borrowing, the fallout could be severe, if not catastrophic. An emergency budget? Well, it's not off the table, and let's not forget Rachel Reeves' promise of no new taxes will be put to the test ultimately. The bond markets are watching all of this very closely, and they don't care much for politics or promises. On Thursday, the government tried to regain control of the narrative by calling an emergency economic debate, which led to nothing. So, as we enter 2025, the FTSE 100 has reached an all-time high, along with the S&P 500 and the Dow Jones Index. These have mostly been driven by the Magnificent Seven, those being the 7 largest stocks in the US market: Apple, Amazon, Meta, Nvidia, etc. A lot of commentators have said that surely we're expecting a fall in 2025 as these stocks cannot continue to strive and drive the markets forward. I have to say that a return concentration in public markets isn't a bug, it's a feature. To echo this, between 1926 and 2023, most, i.e. 58% of all US stocks actually destroyed shareholders' wealth over their lifetime. Pretty dramatic. Just 3.4% of the stocks, i.e. 966 firms, are responsible for the entirety of the net wealth creation of $55.1 trillion over nearly a century. What's more, 120 companies, or just 0.43%, created 60% of this wealth, and 317 companies, or 1.1%, created 80% of the wealth. So, the typical public listed company is a net loss maker over its lifetime. The beauty of indexing, yes, buying the haystack, the global market, is when you combine the performance of all companies, the average outcome isn't just positive, it's extraordinary when compounded over time. Hopefully you've enjoyed this first view from the fields. If anyone has any questions or wants to get in contact, please do let the office know. Please feel free to share this to family and friends, and if anyone else wants a conversation, you know where we are.